How much did you get?
$175,000.
$175,000.
Home equity line of credit is it's a revolving account. It works a little like a credit card, except it's secured.
Did you happen to ask what the minimum qualification is for a HELOC? I'm sure that's important to everybody.
Yeah, it was surprisingly low. It's like a 640.
Okay.
Yeah, it was like a 640. I was surprised by that.
So if somebody has a home, they have equity.
Yep.
They have a credit score over 640.
Yep.
And they have income. Pretty much that's what you need to qualify, correct?
Absolutely.
Okay. More than money, it's about empowerment. Welcome to MSI Wealth Chronicles. My name is Ricardo Mendiola. This is Jesse Hartman. And in the previous episode, we had talked about using other people's money. So we're going to dive in a little bit deeper into that, and we're going to talk about home equity lines of credit. And today we're going to talk about Jesse because he actually just got a home equity line of credit.
Yep.
And so you're going to hear his experience. So let's dive right in. So when did you get your home equity line of credit?
I got the funding on the 28th of last month.
Okay.
And
how much did you get?
$175,000.
$175,000.
Yep.
What was the value of your home?
Value of home came out to currently it showed up at 690.
Okay.
And they allowed me. I owed 389. And they allowed me to get like a little over 80% of what the value of that.
Okay. So they did make you leave 20%?
Yep.
Okay. Did they tell you why? Is that just a standard rule, or was it DTI?
DTI. It actually was about
Okay.
DTI, debt to income. At the time, because part of the reason we pulled out the credit, the HELOC was to pay to consolidate all our debts.
Gotcha.
And because of that, it hurt my credit a little bit because I had all the debt on there, and the DTI affected what they were going to give me.
Gotcha. But let's go and start from the very beginning. So, for all the listeners. So tell everybody what a home equity line of credit is, in case they didn't listen to the first episode about using other people's money.
Home equity line of credit is it's a revolving account. It works a little like a credit card, except it's secured. It's a lot like a secured credit card, except your house is the secured part of it. What they do is you end up with an appraisal, tells you basically how much your house is worth. They take away how much you owe on the house, and then you're able to borrow a certain percentage of that in between.
Yeah.
And
a loan against your equity, right?
A loan against your equity. Basically, what you own in your house above and beyond what you owe.
Okay.
You're able to do that.
And can you tell everybody what are the qualifications for a home equity line of credit? I know they're probably different for every bank, but what was the qualifications for the bank that did your home equity line of credit?
Man, it was really easy, to be honest with you. They needed some information about us, like last 3 months of pay stubs, a couple of W-2s, last 2 years of W-2s.
So
Income. They needed to know the income. They needed to know the house was physically still there, so it had to be appraised, and they needed to know how much it was worth.
Yep.
And they needed to know all the outstanding debts we have, and all of that was tracked. And then at that point in time, they needed to know my credit scores and stuff.
Yep. Do you know? Did you happen to ask what the minimum qualification is for a HELOC? I'm sure that's important to everybody.
Yeah, it was surprisingly low. It's like a 640.
Okay.
Yeah, it was like a 640. I was surprised by that.
So if somebody has a home, they have equity.
Yep.
They have a credit score over 640.
Yep.
And they have income. Pretty much that's what you need to qualify, correct?
Absolutely.
Okay. Can you tell us what the process looked like after? So you fill out the application. They looked at those 4 things. They told you yes. Tell us how the process was.
So the process really was you fill out an application. My wife had to fill out the application. We sent in the documents they needed. Now, when the first time you do it, don't be surprised if they come back with what's called a counteroffer. The cool thing that I found out about it is that even, let's say, because my credit score was at a certain point, it was like 690. It wasn't as high as what to get what I wanted, which actually turned out, by the way, in the long run to be a benefit for me. I'll tell you about that in a minute. But they ended up going, okay, well, you would qualify for this amount if your house covers it, and this is and so they gave me a counteroffer, and we just had to re-sign docs on the counteroffer.
Gotcha. So it's kind of like, I always tell people this, it's kind of like buying a home. It really is.
Oh, yeah.
Other than you don't need a down payment. But you could say that you kind of do need a down payment. That's the equity that you're leaving in there. You said
That's true.
You said that they only let you take out around...
Altogether was 80% of the value, and they left 20% in there. So even if I were to sell my house right now and walk away from my house, I'm still going to get cut a check for about almost $200,000.
Wow, that's awesome.
Yeah, well, about $150,000.
So real quick, I know this is probably a common question for a HELOC. What interest rate did they give you?
They gave me 8%.
8%?
It was 8% interest rate on there, which according to what they have, the HELOCs are based on the interest rate at the time, and not as much as what's on your credit score. If you can make the minimum, this is the interest rate for HELOCs with Randolph Brooks.
Now, is it true that they give you several different options on paying back the debt that you take out?
Yeah.
Because back in the past, whenever you'd get a HELOC, right, and it's basically a loan against your equity, like we just said, and it sits there. It sits there until you use it. And when you use it, that's when you pay interest.
Yep.
And back in the days, it was just one way of paying it back. You know, this is going to be your interest rate. So, you know, there was one way that they calculated how you're going to pay that back. But now these days, you know, they give you several options of how you could pay that, you know, whatever you take out.
Right.
So do they, what options, if you remember them?
I'm trying to remember them. One of them was a lot like working with a credit card. You paid the interest plus a certain amount over it, and you paid that just as soon as you start taking it out, you paid it out. You had the option of only paying interest until the draw period was over. By the way, they have a draw and repayment period. So I'm able to pull money from it for 10 years. And at the end of that 10 years, if I don't refinance it or whatever, then I have 15 years to pay it out. So you could, you know, pay just interest till then and then start paying on the full amount. And there was another one where you could, I don't remember the other one, to be honest with you. It was a much bigger payments. You know what I mean?
I know the home equity line of credit that we got, we used it to build our new home. And as a matter of fact, we just moved into our new home 2 days ago.
Oh, so, congratulations.
Thank
That's
you.
awesome.
So, but that's how we used it. We used it to basically build the other home, the new home that we're living in now. And that's how I found out that there was several different ways that you could pay back what they loaned you.
Right.
And the one that we used a lot was the interest only one. Because we wanted a small payment, because we're still making a mortgage payment on our old house, right?
Yep.
And now everything that we were using for the new house, we wanted a small payment. And so we actually use the interest only option a lot. I know you're only, you know, whenever you make a payment, it's all going towards interest.
Right.
But that might work out for some people. A lot of investors, that's actually, you know, a lot of house flippers, that's actually the method that they use to pay back their debt. They have a home equity line of credit.
Right.
They use it to buy another house. They also use their home equity line of credit to fix up the house that they bought, right? But while they're doing this, what they need a small payment. So what do? They choose the interest only option.
Right.
And why do they need a small payment? Because think about that, they're bleeding money. They're
trying to hold on as much as possible.
They just bought the house with the home equity line of credit. They, you know, are putting money into that house. And they're not going to get any money. They're not going to profit any money until when? Until they sell that house.
Right.
So that's why they want a small monthly payment to get them to basically survive until the finish line, which the finish line is whenever they sell the home. And then whenever they sell the home, they pay off the home equity line of credit.
You just reminded me. I didn't take the interest only option. That was one, but there was another one where you paid the interest plus the small amount.
Yep.
Right. And that's actually what we're doing. So we're paying a little towards the amount we pulled out every month, but it's not, you know, it's not like a huge number, but it is something that'll eat away at it.
And some people ask me, how do you know which repayment strategy do I take? You'll know. You'll know.
Oh, without a doubt.
It's real simple. If you don't want a big monthly payment, then interest only. But the only bad thing about the interest only is it's interest only. Nothing's going towards principal.
Yeah.
So real quick, do you have a yearly fee? on the
not.
home equity line of credit.
No yearly fee.
Yep.
It is that was actually one of the things that you talked to me about when
Yep.
we started. And reason I looked at Randolph Brooks, there was no a yearly fee at all. By the way, one of the interesting things is sometimes when you get a HELOC, depending on how much it is with Randolph Brooks,
Yep.
there may or may not be title involved. And because we did 175 instead of 200 plus, we ended up not having to pay like an additional $2,000 or $3,000.
Yeah, that's awesome.
So it was kind of fortuitous that we didn't get the full 300, because at that point in time we didn't lose extra money, and we can come back when we're in a better place and get that later.
Yep. And some banks do charge a annual fee.
Yeah.
But yes, the one where you went doesn't charge annual fee. Randolph Brooks Federal Credit Union.
Yep.
That's who I use as well. They didn't charge me a yearly fee. So that's why I always recommend it to everybody. Really, if you have a home, you have equity, and you qualify, right? You have credit, you have income. Do it, because the beautiful thing is you get the home equity line of credit, and now it's a loan against your equity that you don't pay anything on unless what? Unless you use it. Yes. So let's dive into that. How did you use yours? Because I mean, there's different strategies, right? I built a home. Well,
Right.
I've had mine for a year, and I've already used it 2 different methods. One was I bought a home, an investment property. So I bought a home with the HELOC, and I fixed it up with the HELOC. Okay. And then the other method is I built a home with the HELOC. So that's 2 different ways that I used it. Tell us how you use yours.
So to tell you the truth, what we started out doing was really, we wanted to gain control of our bills. We didn't have a whole lot in debt, but what we ended up doing, we had a little over $27,000. It was like almost $28,000 in debt. And I went through and looked at it just to give you all some ideas on interest rates that we had. 23, 29, 29, 15, 23%, 16, 17%, 5%, 19. And there was one that was 35.4%.
Wow.
There wasn't a whole lot on that one, luckily, but the average interest rate was almost 25%.
What was 35, if you don't mind me asking?
Torrid, actually. My wife has a Torrid account.
What is Torrid?
It's a clothing store.
Okay, gotcha.
It's a clothing store, and she had and some of the higher interest rates were like the store cards and things.
Really?
Those are usually were the highest ones that
Never
were
paid
there.
attention to that. So a store credit card, the ones that you had were higher than, let's say, your regular, Visa, MasterCard that you have with Chase or Wells Fargo or Capital One.
Anywhere from 6 to 10% higher.
On department store credit cards.
Yes, sir.
Wow, I didn't know that.
Yeah, and that was a particular eye-open piece for me too, because I mean, when you're paying 29 versus 17, it makes a bit of an eye-opening change.
And for those that didn't catch that earlier, right? Your interest rate on your HELOC is what?
8%.
8%. And you guys just heard it. 9.50, 23.99, 29.95, 29.99, 15, 23.99, 16.99, 29.24, and your highest one, 35%.
35%.
Wow.
You said that the other day. I was like, I don't think I have one that high.
Yeah.
And the moment I looked at that, I just stared at it for a moment going, we're paying 35%. That is a third. That is a third of what you spend. You are paying back to them as interest.
So what were you paying on all these accounts? What were your monthly? Do you know what your monthly payment was on all this debt that you had?
The payment we were at, which was above minimum but not by much, was $1,750.
So you're paying $1,700 on all the debt that you had, right?
Yep, on all the debt.
And now you transferred all that debt to the HELOC?
All of it. We owe $1,000 on the car, and that is the only debt that we have that is not the house or the HELOC.
Okay, so $1,000 on the car, your HELOC debt, which you transferred everything over to the HELOC, 8%, and then your house, right?
That's it.
Wow. Okay. And what do you? Tell us a little bit about your savings. What are you saving?
As far as what we're saving, by the way, we are saving. What is it? $1,240 a month that we're going to end up putting directly back into the HELOC.
Okay. To pay it off quicker.
To pay it off because it was going to take me. I did the numbers and it was a little over 2 years that it was going to take us to pay it off the other way. We're going to be under 18 months.
Wow.
This way.
So if you would have continued paying the $1,700 a month, it would have taken you a little bit over 2 years. But now transferring everything over to the HELOC, you'll be at zero in 18 months, you said?
In 18 months or earlier.
So not only are you saving a bunch of time, alongside of a bunch of money as well.
Like $4,000 or $5,000 in interest.
So you're gonna save about $4,000 or $5,000 whenever you pay off this debt?
Yeah, just in the interest side of it, we're saying on. And think about that for a moment. We actually pulled more than what we needed to pull. We pulled $32,000. On $32,000, I'm going to pay $4,000 to $5,000 less in interest than I was going to pay on $27,900.
Wow.
So I'm paying $4,000, almost $5,000 less. I've borrowed more money because we're taking care of a couple of things while we were at it, and we're going to be done earlier.
Yeah.
I mean, there's nothing I can't complain about any of that.
Yeah, that's awesome.
There was a really interesting side effect to all of this, though, that even made this better. We have PMI, which is mortgage insurance. If you own a house, you may have mortgage insurance until you get to owning 20% of the house.
Yes.
Not everybody can get rid of it. Most people can. So check your agreements if you can or can't. But at 20% or at a certain number of years, it comes off, right?
Yep.
Well, we're going to be able to get it off. So not only is it going to save us an additional $510 a month, right, which is almost what we're paying monthly for the thing. We figured up that over the course of the next, I want to say 2 or 3 years, that it's going to save us an additional $9,000 on what we're paying towards the house.
And what he's talking about, I call it a real estate hack, right? if you have a home right now, and it's with conventional. So it can't be with FHA, right? Let's say it's with conventional. And let's say you bought it a couple years back and you have more than 20% equity because you've paid it down over the years. And more than likely, right, real estate always goes up.
Right.
Historically, it always goes up. It increases in value.
Absolutely.
So if you have 20% or more in equity, real simple. You could call your bank and ask them to remove the private mortgage insurance. Typically, all they'll make you do is pay for an appraisal. The bank will send the appraiser out there, and as long as you have 20% equity, they'll remove the private mortgage insurance. And so that's what happened with Jesse. With this, while he was, doing everything with the HELOC, how did you find out about the PMI? Did the bank tell you?
My wife and I were looking at everything, and I went, "We're paying PMI," and she said, "Yeah," and I was like, "Call to find out if we can send the appraisal over."
Good job.
And they said, "Sure." We sent the appraisal over to them, and ta-da!
And I'm
gone.
I'm surprised that they let you use Randolph Brooks Federal Credit Union's appraisal. Usually they want to pull their own, so that's awesome that they used Randolph Brooks Federal Credit Union's appraisal.
I'm pretty excited about that too. But they even said that even if we did it through them, it would have only been about about $500.
Yep.
And when you sit down, even if you take the $500, right, and you're thinking that's 1 month. And I'm gonna save. It was almost like 3 years we had left before we were gonna be under the number for them originally. So even at that, like I said, $9,000 we're saving over the course of the next few years. It's insane.
Did that already take effect? The savings on private mortgage insurance?
Should be through next month.
Okay,
this month now. Yeah, today.
So May.
So May it should be. We should have a reduction on that.
Wow, that's gonna be awesome.
Yeah, I mean, altogether it came out to between what we were paying and everything, we reduced. What was it? A total of our bills by $1,828 a month.
Wow.
That we have a choice on whether or not we pay towards the to the HELOC. But let's say it's a month where we need to, maybe we need $2,000 to do something. We can pay it and we're good.
$1,800 including the PMI, or just $1,800 in savings from the?
That includes the PMI minus the cost of the HELOC. So it's all together. It's like $2,300.
Wow.
So awesome. It's like $1,800 after it's said and done. I mean,
change your life.
Oh, absolutely. I mean, think about it. $1,800. What is that? 4, 5, almost 6, almost $500. $440 a week.
Yeah.
I don't know what that's free money.
So let me get this right. So you've already felt a positive impact from the HELOC, correct?
Oh, absolutely.
Okay. And you said your HELOC was for how much?
My HELOC was the total was $32,000.
No, you're sorry about that. Your
175.
$175,000.
175.
So it's already changed your life, and you've only used $32,000
Yep.
of the 175. And that $32,000, you said you could pay it off in about 18 months, correct?
In 18 months, we're
Wow.
going to pay it off, and then we're going to look at
so in 18
doing
months,
investing.
you'll have your HELOC back to zero.
All the way back to zero. Absolutely.
But also, just so everybody knows, you could keep using it. If Jesse finds another investment opportunity, I mean, what is 175 minus 32? You still have, what is that?
143,000. So
Jesse still has $143,000 worth of a line of credit that he could use for another type of investment opportunity that might arise. Has anything came up yet?
Not yet, but we are actually keeping our eyes out, on that. We're hoping to get into something where it'll be a little shorter for the first one. We don't want to get too long in depth.
Yeah.
But we're thinking about doing like a flip or something like that, going in with somebody else who's done it before. Trying to, we want to get in there and be smart about it, and do it somebody that's got a success.
Yes.
And that type of thing. And actually,
that's
oddly
smart.
enough, we are looking at, unfortunately, not unfortunately, we found a couple of, I do comics and things like that, right? And we resell them. We've done that for years. I found a stock of an old store that we might be able to purchase for a very small amount that we can flip over really fast.
Yeah.
So numbers say I should come out about 20 or 30,000 ahead for about a $10,000 or $15,000 investment.
And the options that you could use your home equity line of credit for are unlimited. I mean, when you told me about that, the comics, I was like, what? I mean, I've never heard of that, flipping a house. I mean, there's just so many, paying off debt. I mean, there's just so many, building a home.
Right.
There's just so many, it's unlimited, flipping a car. I mean, flip anything, buy something and then be able to sell it for more, and then there you go, pay off the HELOC. So I'm excited to see how else you use it.
That's another thing I'm actually looking at is cars. I have for years and years and years built hot rods, right? I've probably owned 24 hot rods, and I've built them, sold them, built a new one, sold them, raced them, had a good time, right? But, some of my biggest turns around in money have been from doing that. And now I have the money if I'm going along and I find something that's rare and unique. In the past, if I had the money, I'd do it. But if I didn't, there wasn't nothing I can do about it. Now I can grab one of those, and run by, grab the car. And in many cases, I turn those things over when I do that in less than a month.
Wow.
And I've walked away, I spent $5,000 on a car one time, turned around and sold it for 25.
Wow.
Walked away with 20 grand. Now I don't have to worry about, do I have the money to sink for this time period? There it is.
And in a past episode, remember I mentioned, it might make more sense to you and also to our listeners. Remember in the episode in the past, I mentioned that hard money lenders, some hard money lenders, all they do is they have their own line of credit.
Yep.
And now they let other people, they loan other people money.
Right.
And basically they just charge higher than the 8% that you're being charged. So imagine letting someone imagine letting someone borrow money, right?
Yeah.
Of course, you do your own research, whatever you might look at, their credit, references, I don't know. And then you charge them, I don't know, 12%.
Right.
There you go. That's what a lot of hard money lenders do. They have a line of credit.
I did not realize that. That's smart.
They have a line of credit, and they just let people borrow some of that line of credit and just charge a higher interest rate than what you're being charged.
That's not a bad idea.
And then they
for
charge
the
an
future
origination charge as well. Not only do they charge you a higher interest rate than you're being charged, 8%.
Right.
But then they also charge that individual an origination charge, 1% of what you're borrowing, 2% of what you're borrowing. So I mean, it's just, you could get so creative on how you could, use that home equity line of credit. And that's why I'm telling you, I recommend it to everybody. I think some people, whenever I'm recommending it to some people, they think I'm trying to sell it, like I'm probably getting paid or
Right.
getting a referral fee, right? Because I truly believe in a home equity line of credit. It's changed my life. and I've seen it change my clients' lives.
Legitimately, it changed my entire financial life.
Yes.
Just being able to
just
gain
catapults you.
just being able to get everything under control. My wife's no longer worried about things, you know, and it's one of those we've. Of course, we had to do some things. Now, you got to realize when you're doing this, we were consolidating debt, right? Well, we can't build that debt back up.
Yeah.
So we made some choices. We literally put a bunch of cards that we have on Autopay, put like Netflix, Hulu, those type of things on them, and we got rid of the cards.
Yeah.
Are they around? No, physically they're not. We literally chopped the cards up, but continue to use the accounts so we didn't lose them.
Yep.
And they auto pay now, so we're down to one card a piece that we carry. The rest of them, if we want to get that card, we got to make a phone call and wait for it to come in the mail.
Yes.
Right? So you have to be smart when you do this. But once we got, I mean, at this point in time, it is so much stronger of a position to be in because if you need something, the money is there.
Yes.
You know, and that's something that that's a place I've never been before. And when we talk about empowerment, the kind of empowerment you get from knowing that there is a reserve waiting for you if you need to, that's a net I've never seen before. In my entire life, I've never had that kind of net.
Yep. That's awesome. Anything else that that the HELOC has helped you out with?
No, other than, the thing I would like to tell y'all out there, and being serious, this is not that hard. I really thought it was going to be like buying a house all over again. It's like buying a house light.
Yeah.
It really is. We put in the information. If we wouldn't have had to have the counter offers come back to us, we probably would have got that done in 2 weeks.
Okay.
Right.
And so with the counter offers, what was your start to end time frame? 30 days?
30 days total.
Yeah.
It was 30 days total. And the longest part of that, and probably 12 or 15 of those days, was waiting for the appraisal to get done.
Yeah. Now, another big benefit as well is, so we all know, if you listen to some of our past episodes, 30% of our credit score comes from debt. By Jesse being able to accelerate,
I forgot about
and
that.
paying off his debt earlier, his scores are going to increase earlier than going with the old method and paying $1,700 a month, towards your credit cards. But your scores have also already increased as we speak.
Oh, yeah,
right?
absolutely. You did ask me if I got something else out from it. It did. It helped me with my credit score. So beforehand, my credit score was 689 to this low 690s, right? As of yesterday, when I pulled the credit score, not everything is marking off yet. So I have the HELOC showing on one credit report and all the other money on it. So I'm going to kind of ignore that score. I'm going to go with the other two, which is 722 for both of the other scores. So I went from like 689 to 688 to 722. I'm almost 30 points.
And let me tell everybody why your scores increase. So as I was saying, 30% of our credit score comes from debt. And they look at several things. The bureaus look at several things in this area of debt. Your total debt is one of the things that they look at. Another area that they look at is your utilization ratio. So let's just pretend. Do you happen to know what your high credit was on all this debt by any chance?
I absolutely do.
Really?
I actually do. If you're looking at the First Capital One card, that is a $6,000 card.
Do you know the total though, by any chance? Even if it's just a average, so I could give this example to everybody.
Oh, the total?
All your credit cards.
No.
Because your total debt, you told us was $27,900.
Yeah.
And let me just give this example. So his total debt was $27,000. Okay, so let's say his
55.
credit limits was $60,000, and let's use $60,000 for easy math.
Yeah.
And your total debt was $27,000. So he had $27,000. Jesse had $27,000 worth of debt on his credit report. That affects our credit scores. And then another thing that the bureaus look at is what was his utilization ratio. You were right around 50%.
Right around 50%. Yep.
Limit, and then $27,000 in debt. That's about 50% ratio.
Correct.
So check this out. Now he added a line of credit for $175,000. So now you could say $175,000 plus your credit card ratio of $60,000. So now his high limit, his limit's right, $235,000. And his debt is still the same right now,
Yes,
27,000. So he went from 50% utilization ratio to, what is $27,000 of 235? I mean, your utilization ratio went down
What, 15%,
10%?
Yeah,
I don't know.
10,
somewhere around there.
15%. Yeah, that's all it is now.
So that's one of the reasons why Jesse's
Now I'm
credit
curious.
score increased immediately, because his utilization ratio went down. His average went down. So not only is he saving a bunch of money,
14%.
14%. Not only is he expediting his payoff, saving a bunch of money, saving money on his PMI.
Oh,
but
man.
his credit score also went up, and it's going to continue going up
Yes.
because you're going to more of your money is going towards principal versus interest, because you have an 8% versus. What was your average before?
25%.
25%.
I did the average overall, 25%. It almost made me cry.
Yeah. And that's another good thing about it, right? Once you start digging to see what your total interest rate is, what your debt is, you start uncovering what you have, and sometimes you'll get surprised of what you have. I mean, it might even make you rebudget.
The other thing they did is I'm actually set up to contact every one of my credit card companies. And again, we talk about empowerment all the time, right? I didn't know I had a 35.4. What is that? Now, if I give it another 60 days, when all of this settles out, I'm expected to be in the 730, 740s.
Yeah.
I'm going to call everybody and go, pull my credit. Or look at my credit. Don't pull it. Look at my credit and give me a better interest rate, or I go somewhere else.
Yes.
And by the way, while you're doing that, give me a bigger limit.
Yes.
And I'm going to do both of these in this process, and I'm going to drag my interest rates down. So when I do pay off my HELOC, if I do use my credit cards, I'm going to be paying extremely less than what I am now. And I'm going to have more available to me. My credit limit is just going to increase over the next couple of years while I do this. So my ability to do anything in 2 years is going to be far surpassing anything I've ever been able to do in my life.
That's awesome.
Without a
happy
doubt.
for you.
I'm excited about it. I'll be honest. I was hesitant to do this at first. I'm like, man, and I even in the process, I'm like, if we charge it back up, and I sat back and I went, no, this is smart.
Yeah.
And then when I got into the numbers of it, I was like, I've been an idiot.
Yeah.
I should have done this 2 years ago.
And that's what I tell everybody. I tell everybody, why not? Why not? There's no negative to it. I told you that.
Yep.
I told you that, there's no negative to it at all whatsoever. No annual fee. If a bank is charging you annual fee, well, then keep shopping. I'm not sure if Randolph Brooks Federal Credit Union does loans nationwide. If they do, great. Go with them. They don't charge an annual fee. But if they don't, just keep digging. Just keep doing research, and you'll find a bank that doesn't charge an annual fee. So if they don't charge an annual fee, why not? Why not have I said this to somebody the other day, a loan that you only use, that's up in the cloud, you could say.
Right.
It's up in the cloud. And you only pay interest when you use it. And the interest is more than likely lower than any debt that you have right now.
Oh, yeah.
Unless, back in the COVID days, right, 2020, 21, home, interest rates, they dropped really, really, really low.
Right.
But I know credit cards, look, you had one credit card that you were paying 35%.
Man, I didn't think I was going to find one of those either.
Yep.
You actually talked about that on other people's money.
Podcasts, yes,
and I was like,
yes.
could you imagine being that person? And I turned out to be.
On credit cards, you are lucky if you get a 15%. I don't think I've seen a credit card under 15%. And yes, 35% doesn't surprise me that you had that. Yep.
It sure surprised me. And the other thing, by the way, one of the things I found out, if you're looking at a HELOC and you decide maybe I don't want to go for the big HELOC, but I want to have some, and I say big, I started out trying to get a $300,000 HELOC. I was approved for $250,000 if the house would have been approved, right? But I got $175,000, and that turned out to be a blessing because I didn't have to pay the $4,000 in closing costs. Yeah. I paid nothing.
So once you got under a certain loan limit, then you don't pay the closing costs?
Yep, and that's a question to ask. By the way, that's a question I learned during the process that if I were to ever do it again, I would ask that question.
Okay, so that's a great question. So in other words, you get approved. Let's say your home has a lot of equity and you've been approved for $300,000. So you might want to ask, at what point, of me decreasing the limit that you're going to give me, will it get rid of the closing costs? Is that correct?
Right. And it's title. It's doing the title. And that's the easy way to ask it.
Okay.
Where do I not have to go to title? And when you don't have to go to title, there's not all that extra charge.
And for you, it was $175. Correct?
$175 for me.
Okay. And that saves you $4,000.
It saved me $4,000 overall.
Awesome. Savings everywhere,
The places that I saved money, I didn't have any idea. I mean, altogether, when it comes down to it, over the next 3 years, this will have saved me my wife said like 9,200, and then it's going to be about $5,000, so 14, and then the two from that, so like $16,000-$17,000 over the next 2 years.
Yeah, that's
I
awesome.
mean, that's a car. That's a car.
That's awesome.
That is a whole car that I just kept.
Yep. And you said your wife's happy, right?
Oh, she's ecstatic. She's got to pay 2 bills now.
Yeah.
I mean, instead of that list, and I will tell you, ladies and gentlemen, I'm not ashamed to just kind of publish the short part of this list, like how many places it is at, but there's got to be 20 different people that we owed money to, a little here, a little there, some here, some there, that you have to keep up with. Your life is hectic when you're paying 20 people in a month.
Yeah.
When you're paying 2,
Yeah.
man, that's easy.
And then happy wife.
Happy life,
right?
Absolutely.
But awesome. So do you want to, unless you have anything else, you want to close us out?
No, I can close us out. I'm excited. Thank you very much for listening to this. If you've got a house, by the way, if you've got equity in that house, you're worried about certain things, my best advice is to look into it, because for me personally, my whole world, as far as my financial place, it's a spot I've never been in my life, having that. So thank you for watching MSI. Yes, sir.
I do want to add one more thing. You do not have to go to your bank. A lot of people, I used to think that. You don't have to go to your bank for the home equity line of credit. For example, Jesse, your loan for your mortgage company is with who?
Wells Fargo.
Okay. And you got your home equity line of credit through Randolph Brooks Federal Credit Union. So
Yep.
just wanted to throw that out there in case, some listeners out there were just going to go to one place, which is their current bank, their current mortgage provider. So, but sorry to interrupt you.
No. So thank you for watching MSI Wealth Chronicles. Tune in the next time. Do us a favor. If you got questions, put them down in the comments below. And MSI Wealth Chronicles, we're building legacies one episode at a time.